Hi guys, I hope you're well. It's DJD FOREX here. And in today's video, I'm going to be breaking down a really textbook example of my trading strategy. I didn't trade this due to the fact that we are in a holiday season, although I did see it and think, wow, what a textbook example. So without any further ado, without waffling on too much, I'm going to get into it. I'm going to show you exactly why I would have entered this trade in normal conditions, my higher time frame context, my medium context, and then my entry drill. Also where I would have set my TPs and where I would have set my stop loss. And hopefully it can give you a little insight into how I trade and how I break down a chart every day when I trade, and also what it would have looked like profit-wise. So without any further ado, I'm going to get straight into it. So, okay, I'm just going to start from the top. I'm going to go to the 4 hour, right? So I don't trade higher than the 4 hour external market structure. Even in this example, there's not much on the 4 hour that I'm going to be talking about apart from this area here. So just from this high to this low, I've got a mitigation target. Okay, so when price was making its way up here, I was expecting something to happen at this 50% of this range here, right? So this is the equilibrium of this range, right? After this big dump down. So to be honest with you, I would have preferred to sell from here and target down here, but I don't think that's really going to happen with the with NQ at the minute. I've also got a few things up here to pay attention to. The equilibrium of this week's range. So from this high to this low, we've got the equilibrium, which is this blue dotted line. We've also got the point of control. So these are unmitigated areas that basically price seems to be drawn towards. These could also be called draws on liquidity. So we had reason to go back up here. So we had some bullish momentum going up here. Yeah, I'm not really going to talk too much on the 4 hour, just that we had areas that we needed to pay attention to, which literally we traded into. So these will become a bit more relevant when we talk about the TPs. But just for now, I'm just going to point these out on the higher time frame. I'm not going to use the 4 hour external market structure for this. It's not really relevant, apart from you've got obviously these highs here and these lows here. You do have a dealing range from top to bottom, but I don't know. It'll make more sense when we get into the smaller time frames. Okay, cool. Just before we start going to the lower time frames, I'm just going to quickly explain my model. And it might make sense about what I just explained just there. All right, so my model is called a BME cycle, right? I'm just going to draw a very textbook example of a BME cycle, and then I will show you even why that's an area of interest for me, this equilibrium here, in terms of a BME cycle, and why I would have expected a sell down. And then basically I'll show you on all the different time frames the BME cycle. It's basically just market structure with a liquidity sweep. So I'm going to draw it, and I'm going to refer to retail terms as well as smart money concept terms, just because I'm hoping that I can break down some of the complicated stuff that comes in the ICT stuff and the smart money concept stuff that some people find a little bit overwhelming. I've literally studied both. I traded retail for a while. I've first of all, actually, when I first started trading, I actually started with smart money concepts. Then I went on to retail concepts, and I've come back to full-blown circle. I'm actually trading ICT concepts now, which is basically smart money concepts. But to be honest with you, when you see the way I explain things, you're going to see that it's all the same stuff. All the blocks, fibs, mitigation zones, liquidity, all of this stuff, like it's all the same. It just has different terms. So hopefully I can bridge the gap. I can explain things a little bit more overwhelming for some people, and just sort of give you a bit of context into like how I trade based on learning all of this stuff, and then basically realizing it's all the same, and then filtering out the stuff that's not that useful and keeping the stuff that was pretty useful. Okay, cool. So I'm going to get into it. I'm going to draw what is called a BME cycle, right? And I'm going to explain to you how it is the same thing as a swing, right? So Do you know what? Let's just draw a swing first, right? So let's just start off with a very traditional swing, right? Of higher highs and higher lows, right? We all know what this is, right? This is a swing, yeah? High, 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 low, high, 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 low, right? And when taking a trade, you are literally looking, so let's talk about this swing point here. You are literally looking for the next best place to get into a trade based on the break of structure and then the pullback. Okay, so most people would be like, yeah, that's my trade. Target that high, stop loss underneath there, or even stop loss underneath here, however you want to do it. That's your point of invalidation, right? So I'll leave it in blue, but just that's your point of invalidation, stop loss below there, right? And take it to the high, right? So this is retail concepts, right? Which is nothing wrong with that. It's how I learned as well. And then you may find that you use a fib. So I'm going to throw a fib on here. I'm going to use a traditional fib with the traditional, levels. This now, right? And this is, this is what we're taught, that basically you get the break of structure here. The break of structure here signifies the continuation of an uptrend. Makes a high, comes back down, finds support and keeps going, right? And people target, the levels that are on this side of the fib. And that's your trade, right? Now, that is all true. There's nothing wrong with this. This is true. But what I'm going to break down is how to get a bit more refined, like how to basically understand this and how to trade this using something called a BME cycle, right? Which is literally balance, mitigate, and extend or expand, whatever you want to call it. And it's the same thing. So I'm actually just going to do the BME cycle next to this swing, right? So you can see it is the same thing, right? Do you know what? I might even just be able to clone this. Did it work? Yep, it did. All right, so we're just going to use the exact same. We're going to use the exact same swing points, okay? Okay, so in this, I'm going to I'm going to break it down like this. 1 hour. Right? This is what it looks like on the 1 hour, right? But when we trade it, we're trading it on a smaller time frame, right? So there's a lot more detail, right, as to how to get a bit more precise about where the entry is going to be and exactly how to basically get a better risk reward. Also, a few things that need to happen before we can be confident that this is the expansion out of there, right? So traditionally, this would just be buying at support and trading out of there. Now with a BME cycle, we're using liquidity to basically get our sweeps to give us the fuel to make that higher high. So I'm going to draw what would be a BME cycle on a smaller time frame. Okay, so I'm going to cut out this. Perfect. Okay, cool. So this is the same as this, right? Now this you might find will be on a smaller time frame. I'm just going to explain the different parts of this. Is the same, but different. But this is the same, but there are things that happened that basically created this push that if you're trading higher time frames with these types of concepts, you're not going to see them. All right. So the first part of the BME cycle, right, is the fact that there needs to be a sweep. To create the block, the order block. All right, so we're going to draw from here to here. This is our order block. So let me get my mitigation tool. Current mitigation tool. All right. So again, it's the same thing. So this down leg here is this down leg here. The break of structure signifies the fact that we're in an uptrend and we possibly will be coming back to get a continuation, right? So this here is here. So let's just quickly draw on here. Breaker structure, same. Okay, now there's a bit more detail in what happens in here, right? So there are zones, mitigation zones, right? So they're a little bit more defined. In this scenario, it would be from top to bottom there. That's fine. But we have smaller zones inside, right? So this zone here looks like it was what actually caused this push, right? So this becomes what is called your secondary mitigation zone, whereas this one is your primary mitigation zone, right? So this is a more refined area in which probably price is attracted to. So when we get price coming into this, we can expect to look for our entry drill. Normally, price will come into this or maybe not even make it to this, right? If price takes this out, it's still valid, but you just need to remember that basically this should have been what held it. So normally it comes into the 50% of this, right? So I'm going to explain the legs and the parts of this, right? So this is called the mitigation zone here, right? Primary, secondary mitigation zone, right? This too is also a mitigation zone and price is drawn to it, but this is not as a strong mitigation zone as these ones because these are the origins of the move. So this is where the move started. So price, yes, will be attracted to this, but this is not going to hold. So what you do sometimes see is price come into this, react off of it, go back up, and then head down for this, right? So some people will take that as a buy, maybe do a counter trend trade, but ultimately price has not come low enough. Now, if we look at this, if we had price come to here, right, with retail concepts, the 0.382, right, you'd know that that's not valid, right? If you're trading a fib, traditional fib, you're looking for that 0.618, right? Or you're looking for the 0.786, right? Nice deep pullback. And then you look for your entry drill here, right? Now, we're not using a fib for our entry or our area of interest, but what we can use our fib for is our balance area, right? So let me just build onto this example. Right, traditional fib, right. What we want to see with a BME cycle, sorry, I'm going to explain BME cycle in a minute. I'm just setting up the parts of the BME cycle. So the mitigation is the M, right? Mitigate, right? So basically, balance is the beginning letter of a BME cycle, right? So when price breaks structure, it comes back to balance, right? So as we can see, as price broke up here, it came back to the 50%, right? That's what we want to see. Price has balanced between this swing, right? So balance, right? Then mitigate, which is this part, right? Then expand, right? BME. So BME doesn't stand for Big Bang Energy, which I think it does, but BME stands for balance, mitigate, expand. So these are the steps that you need to basically trade a BME cycle. Now, these things happen on all time frames, they're fractal, but these are the steps, right? Now, a couple of things that give these expansions their fuel for this move, right? So that should, let's clone this. Right. There's a few things you want to see to give yourself the best chance of this having a nice push up here and breaking the high, right? You want to see so for example, like the balance becomes liquidity. So this becomes liquidity, right? Now, what you also might find that you have down here is fair value gaps. Like, so you may have fair value gaps inside of your pushes, right? So these all become reasons for price to come down to collect fuel to go up. So obviously when prices come down here, taking out this swing point, it has swept it. Sometimes it looks a bit different. Sometimes these are like down here. and they can be like chilling liquidity like that. And price comes down, takes that out, smashes into this fair value gap, and then reverses and goes up there. Right. So basically it's the same thing, but we're getting a little bit more fractal, and we're looking at what's going on the smaller time frame. Right. Now, on your higher time frame moves like this, what you might find is that you have other draws on liquidity, like time-based liquidity, like Asian session lows or previous day lows. These can be used as fuel for this move upwards, right? These are also called draws on liquidity, right? So when price manipulates, say at the market open, price could manipulate straight into this area, take out these lows, take out low resting liquidity or low resistance liquidity, smash into, which are still called supports, you know, a secondary mitigation target, a fair value gap. You've taken out liquidity. You're now building confluence on as to why this potentially now has got enough fuel to now break up here. Now, like I said, this can be used as your higher time frame context to trade, to give you your TPs and also your areas of interest. But this is also your entry drill on a smaller time frame. So it's pretty much the same thing. So for example, if you were in a BME cycle like this, and the market opened, okay, so the best example of what I'm trying to explain here is potentially you could be in a BME cycle, right? And what I'm going to try and do is remove this. Okay, you could be in this part of in a BME cycle. Now you can clearly see that the market is bullish, right? And you're looking for the buy, right? So potentially you want to buy from this area, but prices come down balanced. Actually, let's just move this to here. Prices come down balanced, but we haven't come into this area here. So the draw on the liquidity is lower. So in this scenario, you'll be taking a counter trend trade into the area of the draw on liquidity, area of interest down here, and then basically taking it out there. But what might happen is you come to the market, just going to draw this in orange. This is market open. You come to the market and you're here. So you can't take a buy from here because you're above the 50%. So you'd probably look for a sell opportunity into this area, and then probably the next day you're going to get the buy out of there. So on a higher time frame, this could be where you're at, and your move could actually be a sell into the buy area like this, right? Which then turns into a buy from here, right? Or you could just be patient and wait for price to come into here. But 9 times out of 10, you come to the market and it doesn't always go your way. So you really need to basically know how to trade up and down. But in this scenario here, I would be looking for a sell into my buy area. And then potentially the next day you could get a BME, you know, the buy would be valid for the buy up here. Okay, cool. Right. So just understanding context, you know, higher time frame context, you could be at different stages in this cycle, right? You could be even at, so you can take a BME cycle in a continuation play. So I'm going to draw that here. So for example, you've broke structure. You've broke structure. Basically, the push hasn't finished yet. So you could, after the break of structure, first pullback, take it as a continuation play. All right. So obviously, to be honest with you, actually, I wouldn't take that. To be honest with you, that's the only one I wouldn't take, because then you've got all this area underneath here, so you don't actually know if that's going to continue. Nah, forget that. Yeah, okay, forget that. All right, but I think you catch the gist of what I'm trying to say here. You just need to understand where you are in this, right? So if you want to look at it as a more less complex example, if you're trading retail concepts, normally they would say you just wait. If you're bullish, so, with a trend line, if you're bullish, you just wait for the buy here, right? And you take it up. So they wouldn't normally recommend that you basically sell into the buy area, because then you're counter trend trading. I remember being told not to counter trend trade and wait for the buy, but 9 times out of 10, you wait and you're patient. The move might happen in the pre-market, the move might happen in Asian session, you're not there, or you wait and then it breaks structure and then the whole directions change and then you don't get set up. So that used to happen to me quite a lot. I used to get really frustrated. And then it leads to other psychology problems, like you might start over trading, you might start taking crappy setups. So basically, like, the solution to a lot of my trading problems was just getting better at the lower time frames. And this is where I found the BME cycle. Someone called Marcus taught me how to do this. Right, so now that we understand what a BME cycle is, it's just a swing, right? It's a swing with a lot of precision to it, with liquidity sweeps, draws on liquidity, and like reasons for price to basically go in the direction it's going, right, on a smaller time frame. Right, so let's get on the chart and let's look at an example of this, right? Now, okay, let's go back to why this area was quite important to this trade. Okay, so a BME cycle, I'm going to draw it here, right? So that's your swing point, there to there. There's your breaker structure. There's your tap back into that area, which is your liquidity. Carried on going. Right, now here we go. So as price came up here, it could have swept this and kept dumping, but it's come into its secondary mitigation target, which is here, right? So that's what's happening here. So this was a very strong draw on liquidity, meaning that price wanted to trade back up into this, could have just swept that and then dumped. So it could have looked something like this and then dumped down, right? As per the example I just explained. So that first tap back in, right? That could have been your, your trade, your sell, right? Or price could have come up to here to this secondary mitigation target. Let's get one. Fit back on. Sorry, I know this is a sell example. I know we just did a buy example, but basically it's the same thing, right? So this is your mitigation from there to there. The 50% is there. So price is very strongly drawn to that 50%. Plus you've got your secondary mitigation target here. So it's a very strong draw on liquidity. Plus you've got, sorry, just a bit more context to these lines. This red line here, this dotted red line, is the point of control for week commencing the 7th of December. So actually, no, week commencing the Monday, 8th of December. Right, so this was the 50% of the high and the low equilibrium, right? Also the point of control for that week. So basically very strong drawn liquidity. So basically price had a lot of reason to shoot back up to here, and as it did. So yeah, potentially we could have seen something like this, right? And then down, but to be honest with you, I feel like the market looks quite bullish, especially being December, Santa rally and whatever. But it's just something to pay attention to. So for your TPs and stuff, you would have probably wanted to TP at these areas because they're very, very strong areas that basically price could have reversed from. Okay, cool. So going to the smaller time frame. Right. Now, bearing in mind, we have quite strong draws on liquidity above where we're trading, right? So this box represents the price action for this day. So I hope this isn't too complicated. Let's zoom in. Okay, cool. Let me get rid of these fair value gaps. These will come in handy in a minute, but they might be good for the explanation. Right. Okay, cool. So again, right, we have the higher time frame BME cycle. Potentially we're in an area where we could sell from, right? But that is a strong draw on liquidity. So up here, this is basically a very strong area for us to buy into on this smaller time frame, but potentially we could have a big dump on a higher time frame, right? So we're basically buying into an area that we could potentially sell from, right? So Okay, let's find our BME cycle in this whole bit of price action. Now, okay, I will talk about down here on a higher time frame, potentially. I'm going to draw the BME cycle here, but I don't think we're going to get down here right now. Okay, we kind of reset and created a new BME cycle here to keep going. So basically, this push like hasn't really finished yet until major market structure, internal market structure gets broken, and we potentially could head down to here. We have the point of control for this week. Week commencing the 15th of December. Plus, we have the equilibrium that hasn't had hasn't been mitigated. So this is just chilling. So there's orders here that are basically potentially prone to being taken out. So we could potentially see price correct, come into this area, and then from there we reset and we go back up. But yeah, see what happens. Different scenarios. But again, drawing the BME cycle, this is the last swing down before the breaker structure. We could come up here, balance, bang, and continue, right? That's the BME cycle. But to be honest with you, how it looks like we've broke structure and we are continuing this push, right? So we look like we're still in the push. Okay, so yeah, we will continue to basically BME towards whatever price wants to go to before we get that correction. Or if we do get that correction, we might not get it. We could get a failure of this cycle and it could just break this high, which could basically continue the bullish momentum, and then would have a bigger BME cycle on our hands, which I think you can see here. Bang, 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 bang. Right, so this is happening all over the chart. But anyway, let's get back into what's important, because it gets a bit crazy if you go too high time frame, because I actually trade the 1 minute. Okay, cool. Right, so just looking at what we've got here, right? The BME cycle, like the dealing range, the BME cycle that we're kind of messing around here, it all starts with a pullback and then a breaker structure, right? Or an order block. Okay, so we're gonna draw that here. Okay, so bang, there, break of structure, made a high, pulled back, bit of ranging going on here, liquidity was created, came down. It only just swept that, but that was enough to basically find support here and continue going, right? So I know that's not a perfect BME cycle, but it has the same principles of a BME cycle, basically. So we have the block where the move started. So the origin of the move, it started here. Within here, we have a secondary mitigation zone. And then we have the first pullback, which is the balance, which becomes liquidity. And literally, as we can see, price swept it, found support on the new week opening gap, which is basically an area that basically is created when the new week starts. Always a massive draw on liquidity. And then price continued and hit our point of control from that previous week and the equilibrium, and also the 50% of the mitigation target on that higher time frame. So basically, we had a really strong drawn liquidity at the top. We had some manipulation into this support, or also a drawn liquidity, and then we got the expansion move up. So yeah, it was a real such a textbook like play with such strong draws on liquidity. It was very easy to read. I was watching it happen. I didn't want to participate because I just thought this is going to consolidate, but clearly December's not the worst month to trade. Like I've always been quite careful with December, but it gives setup. So okay, cool. Let me just give a bit more context. So let's look at exactly how I would have traded this. All right. So the move starts with this block, this order block here, right? Now, if we go on a smaller time frame, we can qualify that this is an order block because we got a sweep here, right? Which then pushed us up. Right. So this sweep and then pushed up here, broke structure, continued, right? This basically told me this is a reset of a block. Now we're going to continue. And when we broke this high, that's now the break of structure. So that's the beginning of this move. All right, now just ignore this for now. This is low resting liquidity or also known as trendline liquidity. This also becomes a drawn liquidity. So this is a target for price to come to. Price in this scenario didn't quite make it down. I think it found support here at the new week opening gap. Also, after taking out the previous day low and also the Asia range, the Asian low, that's why we got this reversal here. So it didn't exactly make it down to the 50% of this mitigation, which I was, expecting it to run to come down here and then maybe shoot back up. It just didn't make it. So I'm going to draw again the BME cycle. So there's the breaker structure, puts in a high, comes back down, can't break the new high, sweeps the low, goes break structure, makes a new high, right? Now I'm going to draw the retail fib on here just to show you like our dealing range, right? So just from this sweep here, this is where the move began to this high, right? Which is this high, right? So this is our dealing range, right? I'm just going to, lost it. Yep. I want to throw the traditional fib on there just so you can see what this looks like. Right, so people that trade traditional fibs, so this is your point A, I guess, point B, point C, but then this got taken out, so this became your new point C, and then on to point D, right? So let's just look what happened, right? So here's the break of structure. Actually, do you know what? Let me just put it onto this. This helps a little bit. Nah, it doesn't really. Okay, so the break of structure is here. So let's just start to build. Let's just start to build there, right? Break of structure. Okay, cool. Put in a high, we retrace back the 50%. So we've retraced back to the 50%. So this is the B in the BME, right? Balance, yeah, right? Then we had this out of session liquidity, Asian range, London, got the impulse move, which took out the Asian low, okay? So we've mitigated, okay? We didn't make it down to the 50% of this range here. So this was the mitigation target, the primary, and then the secondary. So we kind of wanted to see price come down to here, right? Which is 50% of this range from here to here. This is our mitigation target here, while taking out the liquidity. So again, the BME cycle puts in 50%, sweeps it and pushes. That's kind of what we wanted to see, right? But we just didn't make it down here. The new week opening gap gave us enough support to basically continue after taking out the previous day low, the Asia range low, right? All right. So can you see though, you've got the 50%. So the balance, price has balanced this swing. So this push up was balanced by this. Okay, so that's what price is striving to do. So this then created liquidity. Also was the previous day low, which is obviously a massive draw on liquidity. And then when we got this impulsive move pre-market, so this line represents the opening bell, 9:30 for the New York session. Price pushed down into the new week opening gap, mitigated it, took out a previous day's low, also the Asian low of the previous session before London, and then reversed. All right. So it's given us the same characteristics of a BME cycle, but it just hasn't done it to it hasn't mitigated this. So it's kind of left this unmitigated, which it can happen. Doesn't have to come down there. But your order flow of the smaller time frames is going to basically tell you if price has changed direction. So that's the next part we're going to get into, right? So what I'm just trying to do is I'm trying to explain to you on the higher time frame why we had a drawn liquidity above here. So why price could have gone higher, right? So that was the mitigation zone for the higher time frame BME cycle to come down. And then I've gone to this price scale or sorry, this time scale or time frame to show you the active BME cycle that we're in now, right? Now, this is all well and good because this is a hindsight breakdown. People could say, "Oh, well, you're just doing a breakdown something that's already happened." That's a fair observation. I didn't trade this, but this is my model. This is exactly what I look for in the market. Just looking at this fib though, you know, if you was a retail trader or you were trading retail concepts, which I traded for a long time, you'd be looking for price to take out the 0.786 level, or at least the 0.618, right? Before you take a buy, because it hasn't gone low enough. But how many times have you sat there and price has done this at the 50% and then gone, and you've missed the move and you have to wait another 2 days for a move, right? That used to happen to me all the time. Like I said, it would just create really bad it would create really bad psychology problems, because then I would then start rushing into other trades, over trading, and just to piss me off a lot, because I'd be so patient, and then your patience can only last so long. So yeah, I just decided to get better at smaller time frames and start reading things like this, and then, you know, here I am now, profitable with this. So right, so now that we've got a higher time frame explained for our draws of liquidity or our targets, let's talk about like how you would have entered this after seeing your confluences stacking for your basically your entry drill, right? So I'm going to take that fib off, just to tidy things up a little bit. I'm going to get rid of some of these. Yeah. I'm then going to talk about, okay, so I'm going to start this part from the fact that we've smashed into enough draws on liquidity for price to reverse. All right. So now we're going to talk about the entry drill, right? The entry drill now is what I look for once I feel like price is satisfied or price has got what it wanted. Okay. So order flow is going to help me with this. So order flow is basically the direction in which the fair value gaps are getting left behind. All right. So I've left these on here. So as you can see, we have, was it 15-minute fair value gaps? Yeah. So I use the 15-minute fair value gaps order flow, or sorry, I use the 15-minute order flow to tell me the direction, right? So until these start getting violated like this one did, I'm still expecting this to be going down, right? So this was the manipulation leg pre-market in the London that smashed into basically the mitigation target that gave us enough fuel to go higher, right? But as you can see, we inversed this fair value gap, right? So this fair value gap here was inversed by this fair value gap, right? Which is a bigger one, right? So going on a smaller time frame, you could have waited. Now, if you'd have come to the market, okay, so at the opening bell, so let's go to the 1 minute. What's important is once price has smashed into this, you start looking for order flow to change direction. So obviously all of this manipulation leg came in and took out, you know, the Asia low, new week opening gap, hit the 50% of it. The previous day low has all been taken out. Now the market opens and price shoots up. So just going to show you, there's nothing you can do with a big candle like that. The market has shot up at open. There's nothing you can do. You have to leave that alone. Your next best, again, it's a swing, right? Your next best place is trying to find a BME cycle on a smaller time frame, which is exactly what we've got here. And I'm going to show you the parts of the BME cycle here to get your entry. And then again, just waiting for order flow to change direction before you take your trade. So I can already see that there are bearish fair value gaps on the 1 minute coming in here. And again, still bearish fair value gap here. And then you get inversed. So this bullish fair value gap has inversed this bearish fair value gap. And that was an entry signal to go higher, right? So let me get everything back on the chart. All right, so order flow has changed, all right, but we're using the 15-minute order flow to tell us the direction, and then we're using the 1 minute order flow pretty much for our entry. Okay, cool. And also just to remember, we have the previous day's high that hasn't been taken out. So there's liquidity there. So this is also a target for our TP. We have the, you know, again, I'll say it before, like I said it before, we have the point of control from the previous weeks. We have the equilibrium from the previous weeks. We kind of got close to it here, but on different charts, it's going to show a different thing. On the different charts, we may have taken that out, but just on this chart that we're trading, we still had that as a target. Yeah, so previous day's high, and obviously the 50% of the equilibrium of that bigger BME cycle. So, we have reason to go up after we've swept these mitigation targets towards the bottom, right? Okay, cool. So again, I'll just explain, during this session, the London session, we got a nice manipulative move down into these, right? And then order flow has changed. So these are 15-minute fair value gaps. All right, now let's draw the BME cycle for the entry drill once we've tapped into basically our mitigation target, right? It's the same thing. So we're looking for a sweep, then a breaker structure, and then again, I'll even throw on the retail fib. I'll even show you the move using a retail concepts, using the fib, right? So let's look at what we need, right? So we need the sweep. We need the last push down for the breaker structure, right? So technically it's going to be, this is the last push down because this respected this, right? So this is the last push down for the breaker structure, right? So we will draw our mitigation zone here. So from here to here is our last push down with a sweep that then we broke structure, yeah? So when I say sweep, I mean, we swept this. So let me just go on a higher time frame a little bit, right? When you're, well, actually it's there. This is the true breaker structure, but on this smaller time frame. But you know what, let's just use this time frame here. All right, let's just, okay, so, all right, let's just draw a structure. Right. This is bearish market structure. That was the last low before the break of structure. So that's your break of structure, that's your retest, and that's your go, yeah? So this counts as the sweep. All right, so that's the low. That's the manipulative sweep of this low here, push up here, break structure, come back in and leave, right? But again, we are going to use a primary and a secondary mitigation zone. So from there to there, that's your zone. Then you broke above. Now, on this time frame, the break of structure, this counts as a break of structure, right? Because we have candles that closed over it and above it. All right. If it was just wicks and then went down, then that would be classed as a liquidity sweep, right? But because we've got candle closures above, even though that did react off of there very aggressively and come down, that could have definitely been classified as a liquidity sweep because we even took out the Asia high, right? Which basically could have, confused people definitely. Because we got candle bodies close above, this told me that basically this was the sweep that basically broke structure and changed the direction, right? So yeah. Now, like I said, I've got a mitigation zone here, and then within that, I've also got another one here. So this is where price came into. So during the BME cycle, I will draw it like this, maybe on a 5-minute. I'm going to draw like this. Expand. All right, now when we go on a smaller time frame, you're going to see that basically, can you see how you had this high? Oh gosh. All right, this is what I'm trying to explain. When price broke this high, it came back and put in. It's a bit confusing. Right. Right. When we broke structure here, we broke up and then we came back down and put in a low, right? This was your balance. Okay. This then becomes liquidity, right? This is your first tap back into the zone after you broke structure, right? This is your balance. So this is your, I mean, we could probably draw a fib here. I'm not gonna speculate. I don't think we have. No, we didn't quite. But this counts as the balance, right? This is the B and BME cycle, right? This is the first tap back in after a break of structure. So this is your balance, right? I'm gonna draw the traditional fib on here from top to bottom. Right. So from top to bottom. Yeah. Actually, we did. If you look here, I'm gonna draw the BME cycle. Relative to this swing point, we could draw the BME like this. That back in to the 50% of this and then out, right? But really the true break of structure was this one, the external break of structure. But relative to this downswing, actually you could call it that one, this downswing here. Yeah. So here, I mean, there's many mitigation zones you could draw here, but this down to here could be this is the swing before the break of structure, right? So this is the downswing before the break of structure. So this is your primary mitigation target. This is your secondary mitigation target. I would say, actually, you could get a bit more. I would say that one there. So yeah, this break of structure here. Price coming back into here to revisit where it broke out from. Relative to this break of structure, let me get rid of these fair value gaps because they're a bit confusing, right? But relative to this break of structure here, right? We got a tap back in, which was here, which literally, I mean, on this chart, probably didn't get swept, but on, if you're trading futures charts where it's regulated and it's one chart, it's not being manipulated. These would count as the first tap back in liquidity. So probably on another chart that got swept, but on this one, it probably hasn't. So again, it's a BME cycle on the 1 minute, which is just a swing. Again, just has liquidity targets that he wants to take out before getting that expansion move out. Now, just a quick, recap on order flow. It's the same thing. There was bearish order flow all the way down into the mitigation zones. So from here to here and from here to here. So this is your primary. This is your secondary. You had bearish order flow. So I'm just going to draw it. Right. So until these get inversed, we're still bearish. Yeah. So your entry was actually on that. We're still bearish here. That was still bearish. And then we didn't, because prices come into here, I mean, probably took out that low on other charts, made it down to where the origin of the move is. This is probably now where price got its reversal. And as you can see, your inverse fair value gap, which is there, order flow has told us that we've reversed. So when you got your first candle closing above this red box, which was there, so on that candle closure, you would have entered. And it depends, like, as long as you got a deep enough sweep, you can put your stop loss underneath the candle that basically inversed the candle that started the push. But I just kind of put it underneath the low. But you that can still come back down lower and come into here. So sometimes you need to put it here. This is your protected low here. So that's at the point of invalidation. So to be honest with you, just measuring up your risk reward, if you've got a 2-to-1, which you nearly do, or if you had your TPs at the draws on liquidity above, which were these zones, that's a 3-to-1, so that's not a problem. But if you wanted a tighter, you could have moved it here and you've got a 5-to-1. That's if you're going to hold. But we'll talk about TPs in a minute. TPs are obviously going to be the areas where price is going to struggle. I'll go over those in a second. I'm just trying to help you understand how you would have traded this move. So you had to wait for price to return to here, because otherwise you couldn't have, I don't know, I wouldn't have really wanted to take this as a continuation to keep going. I would have wanted to take a buy from here. Okay, cool. And that's it. So again, just targeting the highs here. Um, the so TPs would have been, so basically just based on what we've done here, right? Your TPs would have been at the areas in which you would have probably got some trouble. I would have put TP1 here. Now, if we would have broke past TP1 and had no problems, I'd have put stop loss to break even. And then let the rest run, and then you could put TP2 here. And then TP3 would be up top where the point of control was. So there. Final TP. That's where you leave a run. Right. So that's how I would have played it. But to be honest with you, I probably would have been out at TP1 because I'm scalping. I'm looking to hit that quite heavy and be out. $1,000 and I'm done. Or I don't know. Maybe leave a runner, depending on how heavy I got in. If I got in with 5 mini contracts or micro contracts, I would have probably left one on the table and let it run, stop loss to break even. But I don't really like to do that. I like to be done within like 20 minutes of trading. So yeah, your buy would have just been quite simply on that first candle there. Could have had it tight. Could have had it underneath the low. That's still a one, just about. A 1-to-1 is there. But with such high confluence, I was pretty confident. I would have been pretty confident to hold that probably to TP2. So that could have been, yeah, that could have been decent. And that's pretty much it. That's literally how I would have taken this trade. I hope that this, gave people a little insight on how I trade. And that's pretty much it. If you guys like this video, then please subscribe and like the video. Leave me a comment. Obviously, it encourages me to make more. This year, I'm going to really focus on making more content for trading and get my, try and pass on some of the gems that have been passed on to me. Nothing that I have here is original. Everything that I've learned, I've everything that I've explained here in this video was something that someone else taught me. So I'm not like a guru or anything. Um, I'm still a student of the market, still a student of life. But yeah, so yeah, like I said, if you found this video useful, please give me a comment and a like, or message me on Instagram. My socials are underneath the video in the description. And that's it, guys.